Rising concerns over a possible U.S. recession, a possible mid-meet Fed rate cut, and the Japan carry trade all combined to spook equity, currency, bond, and commodity markets.
Britannia clocks in healthy volume growth and sees a good pickup in rural consumption, modern trade, and e-commerce, but rising commodity prices hurt margins. FMCG stocks gain on expectation of higher consumption and flight to safety.
SBI Chairman Dinesh Khara remains upbeat on growth and credit quality even as deposit growth slows, but analysts fret over crimping margins and rising stress going ahead.
Warren Buffett's Berkshire Hathaway likely sold almost half its stake in Apple for over $84 billion, boosting its cash pile to nearly $280 billion. This is being read as a strong signal of frothy valuations.
Hello and welcome to a halftime report. I'm Ekta Patran. With me is Mangalam Malu. Well, it is definitely a red screen, as you can see on the top, and has been from the get-go. We knew this was coming, considering that the US jobs report on Friday was definitely below estimates, sparking concerns that, yes, the US is possibly heading towards a recession. And you got the verdict from the Asian markets today as well, with the kind of carnage we've seen across Asia, such as the Japanese markets, which would be a case in point. And so we're not spared either. We have an advanced decline ratio, which is extremely weak, which currently stands at almost 1:6. For the Bombay Stock Exchange, the India VIX has spiked up, and we have all of the stocks within even the Nifty space, most of them trading in the red.
All Nifty sectoral indices in the red, Ekta. And as they say, you know, the old adage, when US sneezes, everyone else catches a cold. Fears of US recessions, hefty valuations in India. At the same time, you had, a lot of global tensions in West Asia, etc. as well, notwithstanding all those concerns. And it also came back from the weakness that we saw in big tech earnings. I mean, on Friday, irrespective of recession fears, etc., Intel was down 26% on growth guidance cut and lower than expected, jobs, etc. as well. We saw a big cut in all the other names. As we speak, the futures, Nvidia is down almost 5-6% after falling about 8% in the last couple of trading sessions. So there is a big sell-off that we are seeing. The Nifty, as you can see at the top of your screen, around that 24,000 mark. If you look at the big cuts that we're seeing in the market itself, the Nifty down 700 points, the big headline, so to say, the Nifty Bank down 1,400 points, and the Sensex down 2,400 points as well. Spoke about the broader markets. Look at, the number of stocks which are declining, 2,260, which compares with just about 150 stocks which are advancing, all sectoral indices in the red. And what's interesting is that 500 stocks on the Bombay Stock Exchange are at lower circuit right now. So 500 stocks, there is no exit door right now. The narrow door to exit has actually been closed. So 500 BSE stocks at lower circuit. You have 230 stocks on the upper circuit. But remember, no Group A or Group B stock is in upper circuit. So the ones which are in upper circuit actually have their own, limited traders, etc. as well. So those are a bunch of things that we're looking at. As you can see, the headlines numbers, the Nifty down 700, the Sensex down 2,400, the Nifty Bank down 1,400. What really stands out is the India VIX up 50% in today's trading session. And that's the biggest intraday spike that we've seen in the India VIX all the way since 2015. And since 2015 from now, we've seen a lot of volatility, including the COVID day and a couple of lower circuits as well. But a 50% spike after almost 20% spike that we saw in the previous couple of trading sessions as well.
Yes, absolutely. And like you mentioned, the statistics today are actually quite concerning. And all of the corrections that we've seen in the past, may it be even the election day correction, that was more local in nature. Today, we're facing what is a fear of a recession, which is probably going to seep across the globe and probably come down to the Indian markets in some form or manner, though we might be more resilient, which could probably be, showcased in the FMCG stocks today. So that's probably more indicative or more worrisome in terms of what is taking place in terms of a larger trend. But nonetheless, like you mentioned, the BSE is indicating that 511 stocks are currently in lower circuit, 237 stocks in upper circuit. As of now, we have around 57 stocks which are at fresh 52-week lows in today's trading session, 3,400 stocks which are declining on the Bombay Stock Exchange, 548 stocks advancing as of now. So that's the kind of setup that we have. But Mangalam, what is the F&O space telling you?
If you look at the top losers today, they are in three buckets. The first one are anything that have global exposure. So you have, names like Tata Motors, Infosys, the IT stocks, Hindalco, commodity and global plays, all of them lower. ONGC as well. Oil is at close to around $76 per barrel. So those are a bunch of stocks which are lower. Then the other bucket of losers are the ones which had already seen a big rally. So you have your GMR Airports, NCC, LIC Housing, all of them lower as well. And then you have a bunch of these, cash stocks which are lower. Mazagon Dock, Cochin Shipyard, Titagarh, RVNL, Texmaco, all these sort of rail stocks which are lower too. Flight to safety is in names like HUL, Tata Consumer, Marico, Dabur. So you have all those, fresh shots that we're seeing in the system. Samvardhana Motherson down almost 10%, SBI down almost 5% as well. What are the triggers to track from here? Commentary coming in from the Fed. If there is a mid policy meeting for the Fed to cut rates, largely because in one day, the probability of a September rate cut has increased from 22% to 58%. And then we have our own RBI policy outcome on Thursday itself. So does the RBI do something ahead of what the Fed is doing, taking note of what the global markets are saying as well? And to that extent, the Nifty 24,000 mark is extremely crucial. Remember, the reason why it's holding on to that 24,000 mark yet is because there is a fair amount of put writing at that level. The highest amount of put writing is at the 24,000 put. So that's the mark that should come up for you. We are seeing some short covering out there. So 23,750 remains an important support to watch out for. And I'll tell you more about why. And 24,000 call is actually seeing a lot more writing now that we've broken below that. So 24,250 thereabouts on the way up would be a difficult level to cross as well. The Nifty Bank as well, it broke below the 50,000 mark. It's a lot of action at the 50,000 put and the 50,000 call itself. Why is 23,750, 23,800 important for the Nifty? Because the Nifty is below the 20-day moving average. The 50-day moving average comes in at 23,840. And for the Nifty Bank is below the 50,000 mark, and it's below both the 20 and the 50-day moving average. For the Nifty Bank, the important level to watch out for now will be the 100-day moving average, which is 49,450. So the Nifty, it's 23,840, below 24,000 as an important level. And for the Nifty Bank, it is 49,500 thereabouts, which is the 100-day moving average. So those are a bunch of levels that we'll watch out for.
Okay, and we're talking about the equity markets, but we should just keep an eye out on the rupee as well, because the rupee has hit a record low today. It's approaching towards 84 versus the dollar. So I think that would be an important mark to watch out for the currency market for the rupee. So maybe that should come up for you. Currently at around 83.83. Let's see where it stabilizes at this point in time. 84, some way away, but nonetheless, record low currently for the rupee. But let's talk a little more about opinion that we're getting with regards to the equity market. Chris Wood of Jefferies says that the moment that greed and fear has been waiting for, what seems like an eternity, finally arrived on Friday. That is, he says, unambiguous evidence of a weakening in the US labor market at a time when inflation is still above the Fed Reserve's 2% target. He adds the reaction of the money markets shows that investors share greed and fear's long-standing view that the Fed, in event of such an outcome, will prioritize the labor market over inflation. He says money markets are now discounting 116 basis points of easing by the end of this year, whereas before the payroll data, it was only 86 basis points. He adds an intra-meeting cut, the first since March of 2020, now looks likely. Okay, well, that could be something that I think would probably assuage a lot of the concerns of the market, that if in case the Fed does meet on an intra-policy basis, I think that would be important. Like you mentioned, the RBI is meeting from the 6th to the 8th, but they've indicated very clearly they don't follow the Fed. They're going to follow what is right for the Indian economy, and they're not really going to follow what the Fed does.
Central bankers globally, there are three ways of operating when it comes to all these situations. The first, gun in their arsenal is that of commentary. So are they actually going to do any sort of commentary to assuage market concerns or not would be definitely one of the things to watch out for. And that's easier said than, going ahead and cutting rates, etc. as well. The second arsenal, when they move to level 2, are open market operations. What are they doing in the markets? Are they looking at, buying some bonds, or at the same time stabilizing the yields, etc.? So commentary doesn't work, then open market operations. And if open market operations don't work, the third, the most important gun in their arsenal has to be that of rates. So now if that's looking likely, that implies that the top two perhaps may not be working, which is why we're seeing the US Treasury yields fall from about 4.2 in the previous week to 3.79.
Okay, well, let's see. As of now, it's, 1 day of a steep correction that we've seen, at least for the Indian markets. Let's see what the global trajectory is and what the next couple of days will actually bring forth as well in terms of data. We have the ISM data from the US as well. And I think every piece of data from the US will now be tracked very closely to assess and corroborate on where the US economy is headed now. But we'll take a short break. Up next, we'll be connecting with Deepak Jasani of HDFC Securities as the market fall intensifies. Stay tuned.
The market's holding above that 24,000 mark, but it's down almost 700 points. And it's not just the equities market. You know, we're seeing a lot of other assets also seeing a bit of a sell-off, as our ticker team is telling us. The crypto universe has also seen a big, sharp sell-off, nearly $70 billion eroded in wealth, and it's turned negative for the year for major cryptocurrencies too. So the only thing which rises when the market falls is the correlation between all assets. All of them are, seeing a sharp sell-off itself. Typically, these sell-offs are, in hindsight, used as or said to be big buying opportunities. So are they buying opportunities now or not? Deepak Jasani, the head research of HDFC Securities, joins in now. Deepak, when the market wasn't falling, a lot of people were saying valuations are frothy. We will wait for corrections to go ahead and buy. Now we're seeing a big cut in a lot of these names which have seen a big rally, be it these defense names, rail names, a couple of these infra names, and a lot of IT names where people would have missed the recent rally that took place as well. What are you suggesting to your clients? Do you see further downsides from here, stay on the sidelines, or maybe start dipping into this big decline that we've seen in our markets?
Yeah, good afternoon, and thanks for having me. Mangalam, currently we are seeing a combination of economic troubles and geopolitical issues, which has not happened for some time now in the markets. A lot, as you must be aware, markets are driven by sentiments, and now how far the sentiments are punctured due to this and how much time will it take for this to get repaired, we'll have to watch out. We'll have to closely monitor that. Having said that, I think the sell-off temporarily seems to have come to some sort of a bottom, near-term bottom. Nikkei at about 30,500 and US dollar, USD JPY level of about 140.5. These two levels are supports. So we think in the near term, we could see a small bounce from here. But with traders could take advantage of that bounce. Investors, on the other hand, will have to see as to how far the bounce goes from here and how fast is the bounce. So in case the bounce is very labored, then probably it would mean we would form a lower top. So in that sense, I think investors should lighten up even now and in the forthcoming bounce. Buying the dip has always worked in the past. We have seen from June 22 or from March 23, markets haven't seen a very big correction, and every dips have been taken advantage of. So this time around, I think it would be wiser to hold back a little before jumping in the buy on dips kind of a strategy.
Okay, so just to get it clear, Deepak, today, if somebody wants to deploy money into the markets, you tell them to hold off and probably assess what's going to take place with the global markets. Right. Because the geopolitical developments are also not yet over for the time being. So every bounce may be sort of taken advantage of from now onwards. So one will have to let the market settle down. Unless the bounce is very sharp, I think they will get sold into. Okay.
What sectors would you look at putting money in right now? Because, the ones which are doing well are the ones that typically do well during flights to safety, which is the FMCG space, which is mildly higher right now after a spate of underperformance in the past as well. We've seen, some of the pharmaceutical names also see some buying. Would you buy the ones which are doing well right now because they haven't done well in the past? Or would you look at buying, themes which are seeing some profit taking like defense, rail, infra, all of them, which have structural levers but are extremely expensive?
So we would stick to the traditional defensive for the time being. The FMCGs and the pharma. I think IT, there may be some more downside in case the slowdown gets accentuated globally.
Okay. Well, I just want to extend that point, Deepak, because one of the queries that we get from a lot of retail investors is what they should do with a lot of these PSU or PSE stocks that they have invested in and which they're sitting on very good gains with. For example, the Nifty PSE index itself, as we all know, has outperformed. It's up 41% this year itself. But is it prudent to probably just take some money off the table now? For somebody who's probably sitting on a good amount of profits, one. And two, would you probably look to re-enter these stocks or enter these stocks at these levels?
Yeah, so as I said earlier, I think it may be a good idea to sell even now and also in bounces, except for in case you are forced to remain invested in equities. So in that case, I think you can shift gradually to the defensives, but otherwise, the sectors or stocks which have seen heightened interest from the retailers and HNIs over the last few quarters, I think will continue to come under pressure. And it may be a good idea to take profits off and sit on cash for some time.
Sit on cash for some time. How much cash do you think one should sit on, say, because mutual funds are sitting on closer to 7 to 8%, at sometimes even 9%. Some of the PMSs are sitting on 20, 25%, etc. What proportion of cash do you think should be good? And should one also look at gold as an asset class right now, given the sort of uncertainty that we're facing globally, despite the rally that we've seen in gold?
So gold allocation, we have always been advocating 5 to 10% of your financial assets should go into gold. And that stays even now, because in an uncertain world, I think gold can at least save your capital, if not give you appreciation. Now, as far as cash levels are concerned, I think unless you are forced by regulations or by compulsions to beat the benchmark, you have the flexibility to go even 40-50% into cash. This is basically for retailers and HNIs. Mutual funds and PMSs have the other two compulsions, so they may not be able to raise capital to that an extent.
Right, just a correction, Ekta. We were seeing crypto has lost $70 billion in value. It's actually $270 billion. Our ticker team just alerts us $270 billion in value lost in alternate assets as well.
Yes, absolutely. And that's exactly why gold has become this topic of discussion as well. But Deepak, just wanted your thoughts in terms of the entire IT space now. How would you approach it, considering that there are these gyrations of, negativity which is coming out from big tech? In that context, how would you approach a couple of these IT firms?
So, in IT, I think the visibility of large contracts or TCVs, as it were, may still be lacking for the next 1 or 2 quarters. So, in that sense, they may optically look cheap compared to the past valuations, but their growth rates have also come down. So, I think IT stocks are typically they are trading plays. So, in extreme sell-off, you get into them, ride the 10 to 15% up move and get out unless there is a sustainable improvement in the visibility of order flows.
Final question then, what about valuations? I mean, at 25,000, Nifty was closer to 22 times 1 year forward earnings. And now we have nearly 86% of the Nifty weight having reported earnings. So far, it's been a little bit of a mix because we saw earnings downgrades of nearly 1.2% of the Nifty so far for this year and almost 1% for the next year as well. On a valuation check, what have you made of these earnings that have come so far, and what looks good post that and what doesn't?
So as far as the valuations are concerned, I think there are key issues to be monitored. One is the final outcome of the monsoon, its spread and intensity once it finishes. We have seen pockets of excessive monsoon and shortage of monsoon in different areas of the country. So ultimately, by the time end of September, how does the monsoon sort of exit? That will have to be monitored very closely. Q1 numbers, the balanced numbers, I think we will have to see. As you mentioned, it has been a mixed bag. there is struggle on the top line and also margins for quite a few companies. Asset quality seems to have come under pressure after 3 or 4 quarters. So those are the worrying signals. There is a US presidential election in November and there are state elections in October in India. So those things will have to be monitored. Now, valuation-wise, I think we will have to in case the sentiment remains shaken or poor, despite good earnings expectations, the valuation can slide down, and analysts will at that point of time rush to sort of downward project the estimates.
Right.
So, in that sense, I think valuations will become attractive only when we are closer to 17, 18, or maybe 18 and a half times earnings.
Okay. All right, Deepak, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's the view coming in terms of the markets. Just want to point out that a lot of the stocks, say, for example, the M&Ms, which have already given returns of around 54%, ONGC, which is up 51% this year, BPCL also, which is up around 50-odd%. All of them are down anywhere between 2 to 6-odd%. 6-odd% for ONGC at this point. It's the top loser on the Nifty. So sharp cuts coming through there. We'll take a break, but we'll continue with our coverage on the markets. We'll be talking technicals. Manish Hathiramani of Deen Dayal Investments will join in with some trading calls. Stay tuned. Welcome back. Well, we do have Manish Hathiramani of Deen Dayal Investments joining in on the show to discuss the technicals now. Manish, hi. Welcome to the show. Well, tough day. It's all in the red right now. But what would your approach be? Do you think that maybe a buy on dips would be prudent?
Good afternoon, Ekta. Not so soon for sure. Not because I feel that all hell has broken loose, but because we have triggered that level of 24050, which was the lows around the budget day. While we are trying our best to maintain that, we are still trading below that. Should we close below this 25050 level? I think the chartical terms for the short term becomes bearish. A break of today's current low also can take the Nifty down further. I would be working with levels closer to 23,300.
All right, 23,300. If it does not cross past that budget day high today, that's quite a call. Manish, typically you do give big calls. Individual stocks, what is it that one should do then? Because, we are seeing a sharp sell-off in a lot of these names which had seen a rally and some flight to safety in FMCG and pharma. How are you positioning yourself on stocks?
Well, I think if Nifty does break this 24050 on a closing basis, maybe a few minutes before that, I would be looking at two sell calls, namely TCS and ONGC. TCS would be a sell for a target of 4090, stop loss of 4290. A structural breakdown has been seen on the stock. We first broke the supports of 4300 with good volumes. That happened on Thursday, Friday last week. The weakness has been further cemented with this morning's gap down opening. The second one is on ONGC for a target of 290, stop loss of 330. Large volume blocks have broken this stock also around the support levels of 315. With a favorable risk is to reward, the stock can go down to 285 to 290 levels.
Okay, all right, Manish, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's the view coming in on the technicals. We'll take a break. Up on the other side, we'll get you more on the markets. Connect with Daniel Morris of BNP Paribas Asset Management as Global Markets. Do take a deep dive.
Welcome back. The Nifty is still holding below that 24,000 mark, closer to 23,970. Reliance is at the low point of trade as we move towards the European opening. Where do we go from here would be the big question. But all of that will also be impacted by what macroeconomic data is currently underway in the world. More than that, the currency impact as well. So we have who better than Lata to tell us exactly what's taking place in the yield space around the world, the macroeconomics of it all, and the currency impact. Before we go across to the expert, we have our in-house expert with us, Lata.
Well, though the headlines may say, lowest in 2 years for bond yields, lowest in 26 months, I think, and lowest rupee ever record, we must know that it is a very small move. The story in emerging markets and in India is a question of not reacting so much to the turmoil that we have seen in the US markets, in the global or in the developed markets. Just look at the dollar index. It's fallen from 104 on Thursday, before all the data came, to about 102.97. That's a very big index fall, over 1% in terms of the dollar move itself, such a large currency. But look at Asia. The yen and the ringgit are up 2.2%. I mean, because the dollar has fallen, they are up versus the dollar. The Chinese renminbi and the Filipino peso are up 0.2%. The rupee and the baht have fallen, but fallen how much? 0.1%. So although it may look like a record fall for the rupee, it's not fallen much. To be fair, we understand from dealers that the Reserve Bank may have come and sold dollars. But in any case, it's not a volatile fall like you're seeing in the US equity or the global equity markets and even the Indian equity markets. The point is the kind of fall that we have seen in the global markets is led by the US fall, the US equity fall, and the US tech fall. So it need not necessarily be a big macro fall for Asia. And again, coming to the bond yields as well, the bond yields fell by 20 basis points in the US. And if you compare it from July 1st, the US yields have fallen by some 80 bips. They were 4.5%, the 10-year yield in the first week of July. And now they are standing at 3.7. So it's, like an 80 bips fall. But what is the Indian bond yield fall? It was 7%, 7.01 in the first week of July. And now it is 6.84, all of 16 basis points. So we must accept that this is not disturbing Indian macros just yet. But it is just yet. Already there is a whisper in the street that the Reserve Bank may have to change its stance as early as the upcoming Thursday policy. It's saying a withdrawal of accommodation at a time when, the Fed will probably supply liquidity and supply, rate cuts, probably 50 bips, probably intermeeting, may be a bit of a, out-of-date policy, and they may, even if they don't change the stance itself in the policy statement, they may indicate some dovishness in the press conference that follows the monetary policy.
Okay, well, important RBI policy to monitor there then. Lata, thanks very much for that. We do have Daniel Morris, Chief Market Strategist, BNP Paribas Asset Management, now joining into this conversation. Daniel, I'm sure you must be working the phones, talking to your clients. But, the key question, which Chris Wood, in fact, mentioned in his report, is that there could be an intra-meet by the Fed in order to assess whether they should cut rates. Is that a possibility?
Well, certainly, but I think we want to have a little bit of perspective here. Certainly the markets have moved a lot. But number one, it tends to have been those markets that were already up significantly this year. And if you look at the year-to-date returns as of today, those numbers are actually still quite good. And you can imagine that if it had been a straight line from January 1st to this level today, without the volatility, frankly, a lot of investors would be quite satisfied with those figures. Secondarily, even if the non-farm payrolls labor market data in the US was a bit disappointing, we're really not seeing other economic indicators at all pointing to a recession. And also keep in mind that the labor market is a lagging, not a leading indicator. So we really want to be looking more, say, at PMIs to get a sense of how well the U.S. economy, at least, is doing.
Right. So what's your view on the impact that, the JPY US carry trade unwinding is happening? I mean, a lot on the street were anticipating that. Now that it is happening, would you be able to quantify the sort of impact?
Well, I think it's quite clear when you look at the Japanese equity market. And one of the worries that we've had so far this year, and one of the reasons that we've had a neutral rating on Japanese equities, was the worry about the vulnerability of the currency. And if anything, the currency had continued to weaken even as the Bank of Japan had tightened rates. which seemed a bit surprising. We had expected the currency to strengthen sooner. Now it has in a very significant way. And then as anticipated, the impact on the equity market is quite large. And it's that uncertainty really around the currency that remains without question the fundamental issue for Japanese equities.
Okay, Mr. Morris, what's your in-house estimate of how much more the dollar can fall?
I'm sorry, can you repeat that? This sounds a bit low.
Yeah,
What is your estimate in terms of where the dollar index could move, or how much could it correct?
Well, certainly no estimate on the degree of the change. I mean, clearly it's going to depend on primarily on the economic data. If we think broadly the strength of the dollar that we've had so far, it's been premised on a growth differential, certainly say relative to Europe, and much of the rest of the world that was in the U.S. favor. Interest rate differentials with the Fed. At this point, being relatively late to the game, if it comes to cuts in September, those will be the key factors. I mean, really, we're going to be looking for what kind of communication we get from the Fed. For example, would there be a meeting before September? Would they envision a 50 basis point cut? That'll feed through the dollar, and that's going to be the key factor.
But would you believe that there could be sell-off of EM markets like India as well? By global funds, or do you think that may come? I mean, can there be a growth scare in countries like India?
To be honest, for India, I think it would be less a growth scare. People have been talking about valuations for Indian equities for a very long time. Nonetheless, the market kept going up, and if anything, recently compared to many other global markets, it still performed relatively well. But I think now that question is going to become much more pertinent to investors when they see a much less supportive global environment for risk. Markets with high valuations are going to be one of the first things that they look at.
Right, just a final question before we let you go. Typically, the order of action from central banks usually is commentary number 1, open market operations number 2, and then perhaps rate action number 3. What kind of possibility do you ascribe to a mid-Fed meeting cycle cut? I mean, are you in that camp?
At this point, no. We are anticipating a single cut in September. And then another one in December. But obviously, when the facts change, sometimes you do have to change your view. But at this point, that's our expectation through the rest of the year.
Okay, all right, Daniel. Thanks very much for joining in and speaking with us. So no intra-meet rate cut expected from BNP Paribas Asset Management. They do expect the Fed to probably cut rates in September and then in December. We'll take a short break. And on the other side, we'll get you more details on the markets. But before that, we do have another macro call. We'll take a break and we'll be back with more. Stay tuned. Points, low point of the day. There's no respite which has really taken place in terms of the advanced decline ratio. So that currently stands at around 1:15 on the National Stock Exchange. So only 147 stocks advancing to 2,287 stocks declining on the National Stock Exchange. In terms of stocks, remember that a lot of these stocks, such as IFCI, which has run up around 159% this year, is seeing a cut of around 7.5%. So there's profits being taken off the table there. IRFC, which is up around 81% this year, is seeing a cut of around 6%. And from the frontline space, we've been pointing out the likes of M&M is showing a steep cut of around 3.4%. But there are steeper cuts in stocks such as ONGC, which is down around 6%. So do watch out for that. A little bit of green seeing in the FMCG stocks. So HUL is just about holding its head above the water, along with Britannia, which is up around 0.4%, Nestle, as well as Tata Consumer. Not even pharmaceuticals in this entire defensive buying, only FMCG, which is managing to hold up. We'll take a break and be back with more. Stay tuned.
Welcome back, and you've joined us for an exclusive conversation with Nidhi Khare. She's Secretary, Department of Consumer Affairs. Ms. Khare, hi, thank you so much for joining us. And let's start with the good news first. And the monsoons have been good till time. The sowing numbers look better as well. So how are you looking at the overall ongoing sowing numbers? And of course, till when do you think that the sowing would be completed?
That we have come out of the El Nino effect, which meant for the past 2 years intense heat and lower rainfall, and because of which all the agricultural produce were getting impacted. We are now coming out of El Nino, and therefore we see a very good monsoon, and this is what was also predicted by IMD. With better rainfall, this year we will definitely see a very good production of not only pulses, the kharif pulses like urad and tur. We will also see very good cultivation of onions, tomato and other such crops. So this is providing me a lot of relief because with better production, I am sure consumers are going to not only have better availability but also at a better affordability.
You mentioned pulses, and that clearly has been in red zone for quite some time, most of the last 1 year as well. With the current sowing one and the kind of imports, various duty cuts that you have given in, would you say that you are in a comfortable position as we head into festivals?
As you would know that we have made the imports under the free regime only to make sure that because there was a production fall this year in chana, the prices were rising. So basically we wanted to make sure that if pulses are available in any corner of the world, they can make their way to India, and so that the consumers also get it, their access can be improved. This would also make the prices stable, and as we can see that because of now good monsoons and because of good sowing of kharif pulses, now things are looking better, and we already see at least 10% discount, downward trend in the wholesale prices of all the pulses. Chana is still stable at a very high price, and therefore we had improved the availability of yellow peas. I think yellow peas will also support and sustain for the gap that we have in chana. The prices are expected to be now showing a downward trend in the retail markets also, and including chana also. We keep monitoring the prices from all the 550 centers across the country, and we are keeping a very tight vigil on the prices that are faring.
Ms. Khare, your ministry and the Ministry of External Affairs has been talking to Mozambique because there has been an issue on pulses imports from there. What is the situation like right now?
There were disturbances in the in the supply of pulses from Mozambique and also other Eastern African countries like Malawi, Sudan and so on. However, because both the Ministry of External Affairs and Ministry of Consumer Affairs were working on it, we have made our request to the Mozambique government very clear, and we are trying to get seamless dispatches of pulses. These 1400 containers which are arriving in India very, very soon, and there are other 400 containers which are also on the way. I think these, with the new harvest which is coming in both Malawi and Mozambique, we will be getting seamless dispatch from there. I think both the countries are in agreement about uninterrupted flow of supplies, especially in view of the festival seasons which are coming up. We have already, we are working at different levels, and I think the mood is very positive and very, very cooperative.
Sure. There is also high inflation that we've seen in the recent few days in perishable commodities, whether it has been greens, tomatoes, onion, potatoes. We do know that the government has had to intervene in case of tomatoes, but would you say the situation is better now, as you mentioned?
I think in the intense summer that we saw, the green vegetables, the prices went up. But now with the monsoon all over, I think the green vegetables prices have also come down. Potato is, it is stable. In fact, in all the three commodities, potatoes, onion and tomato, it is stable. In tomato, we had to make a small intervention in a few places where the prices had breached 100 rupees. And so both in Delhi and Mumbai, we started through NCCF retail sale of tomato at 60 rupees, and then it was further down marked to 50 rupees. And this also resulted in cooling of prices in the retail market. Now the prices are very, very comfortable. So I see no problems in prices of vegetables, including potato, onion and tomato.
That is good to know, Ms. Khare. And a final question to you then, and this is on the issue of spices being contaminated. And we've seen various reports, international and Indian, talking about this. We do understand that you're working on FSAI with this, but do you think that that is yet another issue that has been sorted?
This issue, because it's a food item, it is basically FSSAI, which is a regulator for taking action. And when we came to know about it, we had flagged this issue with FSSAI, and FSSAI, as you know, has taken action, very strong action against the, the people who were perpetrators. We have to keep, a constant vigil on the quality of food items which are being, made access to the consumers. And I think we will continue to do that work.
Ms. Khare, as always, thank you so much for joining us here at CNBC-TV18 with all those updates and in the sense on what the government really seems to be doing in sense of food prices and, of course, in sense of availability and affordability there. But with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.